Well, good evening, everybody, and thanks for coming in on time. And I can see everybody's non-smiling faces as they turned off their cameras, but it is past a certain hour, so I understand. But welcome, welcome. My name is Liz Pineski. I'm the CEO of the American Chamber of Commerce here in Abu Dhabi, and it is my pleasure to present to you today on behalf of our wonderful Legal Affairs Committee, the great folks coming in live from America with Flott Co. On behalf of our Legal Affairs Committee chairs, Mr. Murtaza Khan and Mr. Charles Lobach. Allow me to introduce your speakers on the subject matter today. We're very fortunate to again be joined by the wonderful Stephen Flott, Esquire, Principal of Flott Co., a long-term friend to AmCham Abu Dhabi, and I can personally recommend Flott & Co. and Mr. Flott for your tax needs. We also are welcomed by Natalia Kosiak, who is working alongside Mr. Flott, and their associate, Mr. Kyle Glickson. Today's subject matter is really important to us all. The tax day for expat filers is just around the corner, but I'm sure we'll all file extensions. But this is designed to help you get up to speed on some of the changes that may or may not be in your knowledge bank at the moment. Couple of quick housekeeping things. This event is being recorded, and the recording will be available to you as your attendance and as well as on our AmCham Abu Dhabi YouTube website. As well, if you have questions, please either save them for the end of the presentation or put them in the chat box and we'll go through all of the questions at the end of the presentation. The presentation is expected to last between 45 and 50 minutes, after which time we've allotted plenty of time for your specific questions. So to kick it off, I would love to welcome Stephen Flott. The floor is yours, Mr. Flott. Thank you again for joining us.
Thanks very much, Liz. Nice to see you again over the distance, virtually at least, and nice to be here with all of you. You can, sure, the biographies aren't that important. It's there for your use. This is the overview of the topics we're going to be covering today. We're going to start with the tax filing obligations of U.S. persons living abroad, and then we're going to go to the foreign earned income exclusion. You can read on the slide the various topics that will be covered. Now, there are some subsidiary topics that will be covered in each of these sections that aren't necessarily listed here. And let's go to the next slide. Tax filing obligations of U.S. persons living abroad. Next slide. All right, the key here is that a U.S. person includes a citizen or a green card holder. Those are included in the term U.S. person. So we're just going to use the term U.S. person as we go through this rather than sort of citizens and legal residents, etc. They are subject to tax on their worldwide income from all sources, irrespective of where they live or where the sources of income are. The tax is levied as provided for in the U.S. Internal Revenue Code, even if no income is from sources in the U.S. Now, defining who is a U.S. citizen is an important element of this. Anybody born in the United States is a citizen of the United States by birth, irrespective of how long they were here, how long their parents were here. Anyone born to a U.S. citizen outside the United States, if both parents are U.S. citizens, is a U.S. citizen by birth. Anyone born to a U.S. parent, citizen parent, who can pass on his or his citizenship. Now, there's an issue here. There are some U.S. citizens born in the United States who are U.S. citizens but don't have the right to pass their citizenship on to their children. So that is an issue. But let's assume that we have a U.S. citizen parent who has the power to pass on their citizenship to their children. If they register the birth of their children at a U.S. consulate and obtain something called a consular record of birth abroad, they are U.S. citizens at birth, and that consular record of birth abroad is their U.S. birth certificate. And obviously anyone naturalized as a US citizen is going to be a US citizen. The key takeaway here is even if you don't live in the United States, if you're a US person, you still have a US federal income tax filing obligation and potential federal liabilities. Next slide. Now, the filing thresholds, who has to file? Well, again, you can consult this slide at your leisure. The fact is that there are different filing levels. The one I want to point out most particularly is the one at the bottom. If you're a US citizen married to a non-resident alien, and you're going to file a married filing separately return, your filing threshold is $5, which might as well be zero in today's world. And so you have an absolute obligation to file. If taxes are owed, this is one of those issues that probably not anybody going to challenge, but the fact is, if your tax filing deadline for US persons living overseas is June the 15th, but notwithstanding that, if you owe taxes for 2023, you should have paid them by April 15th. And if you haven't, and you do owe tax, you are going to be subject to interest and penalties, fairly minor, hopefully, but that is the issue. You must pay your taxes even though your return isn't due until June 15th or maybe October 15th if filed on extension. And it is important to note that if you cannot file by June 15th, you have to file a form to get an extension. Next slide. Now, many US persons living abroad, obviously, who came from the States, they may be over, oops, go back, yeah. Nope, back. There we are. No, next slide, there we go, yeah. The issue here is whether you have a state income tax filing obligation. Now, generally, US people living overseas do not have state income tax filing obligations or state tax liabilities. There are exceptions. Obviously, if you're a US person and you own property, say in Nebraska, and you rent that property out, then you have Nebraska source rental income, and you're going to have to file a state return. The other thing that some people overlook is they lived in Florida for many years. They've now lived in Abu Dhabi for 10 years, but they still have their driver's license, their state voter registration card, or similar indicia of residence. That might give rise to a state income tax. Now, remember, each state sets its own rules of taxation at the state level. So what may be taxable in New York, or the rules applying who has to pay taxes in New York, may be very different than somebody in Delaware or in California or in Illinois. Now, generally, persons intending to live indefinitely overseas should take steps to sever their state connections when possible. Just removes the doubt and likelihood of being chased. The other option, of course, is to file a non-resident state return reporting no state taxable income. All right, that wraps up my section. Let's pass on to the FEIE. Next slide.
All right, thank you, Stephen. So now we'll talk a little bit about the foreign earned income exclusion and housing exclusion / deduction. So next slide, please. So while US persons living abroad still have US tax filing obligations as a US person, many are able to take advantage of what's called this foreign earned income exclusion, or FEIE for short. So what is the FEIE? The FEIE allows qualified persons to exclude a certain amount of foreign earned income from their taxable income under Section 911 of the Internal Revenue Code. So let's first break down, what does foreign income mean for US tax purposes? The source of personal services income is determined by where the services are performed. So income from services performed outside of the US is foreign source income. It doesn't matter where the employer is within the US or if the customers are within the US. It is solely based on where your services are being performed. So the next question is, what does earned income mean? This includes things like wages, salary, tips, bonuses, reimbursement for moving expenses, and the net earnings from self-employment. So earned income does not include items of investment or passive income such as interest or dividends, rental income, retirement income. These types of income cannot be excluded under the FEIE. An important exception to note from the general rule is that employees of the US government, such as US diplomats working overseas, do not qualify for the FEIE for their earned income they receive. So that's one thing to note. The next question is, how much earned income can you exclude under the FEIE? This amount is adjusted each year for inflation. For reference, in 2023, the exclusion is 120,000 US dollars. And for spouses that both qualify for the FEIE, they can take a combined amount of 240,000. Now, the 2024 exclusion, which will be for the next filing season in 2025, is 126,500. So 253,000 combined if both spouses qualify. Any excess foreign earned income that's above these FEIE thresholds will be subject to income tax in the US. There are some important limitations to note, that the FEIE only applies to ordinary income tax. It doesn't change the self-employment tax if you receive net earnings from self-employment. So an example, if a self-employed person with $70,000 in net profit qualifies for the FEIE because they have services that they perform outside of the US, they can exclude that entire amount from income tax under the FEIE, but this does not shield them from self-employment tax on that $70,000 in net earnings. So that would be about $10,710 in self-employment tax, which is the 15.3% tax rate. You could go to the next slide, please. So who is qualified to claim the FEIE to exclude their foreign earned income? The first requirement is that your tax home must be in a foreign country. So what is a tax home? A tax home is generally where your regular or principal place of business or employment is. It's essentially the location where you are indefinitely engaged to work as an employee or self-employed individual for the foreseeable future. So it's important to distinguish between a temporary versus an indefinite work assignment. The general rule is more than at least 1 year would be treated as an indefinite work assignment. However, you're not considered to have a tax home outside the US if your abode is still in the US. Now, your abode is based on where you maintain your family, economic, and personal ties. So temporary presence in the US or maintaining a dwelling in the US does not necessarily mean that you have an abode in the US. This is really a facts and circumstances analysis that's based on each individual's unique situation. It's not a bright line test, so to speak. And the second requirement, assuming you have a tax home in a foreign country, is whether you can meet either of the bona fide residency test or the physical presence test, which we will delve into on the next slide, which you could advance, please. So the first option is the bona fide residency test. To satisfy this test, you must reside in a foreign country, otherwise known as your tax home, for an uninterrupted period that includes an entire tax year, which is just January 1 through December 31st. The intention to eventually return to the US one day does not preclude you from establishing bona fide residency in a foreign country. This, again, it's another facts and circumstances analysis. It's based on a number of factors that are considered on each individual situation. We note a few of these factors, such as the nature and length of your residence abroad, your housing ties in that foreign country, family ties, paying income taxes in the foreign country, as well as your residency status in that country. One important distinction with the bona fide residency test is you do not have to calculate the days that you're in the US during a tax year. So you can leave the country, your tax home, for temporary trips back to the US or elsewhere for vacation or business. However, long extended stays in the US may begin to undermine your bona fide residency status abroad. And you must have a clear intention of returning from these trips without unreasonable delay to your tax home, your foreign residence. So if you cannot satisfy the bona fide residency test that we just described, there's also this test called the physical presence test. Now, for this test, you must be physically outside of the US for at least 330 full days during any consecutive 12-month period. So these days can include days spent outside the US for any reason at all. It doesn't matter. It means business travel or work days are counted towards the 330-day threshold, as well as time spent on vacation. Another benefit of this test is you can choose any successive 12-month period that gives you the greatest exclusion. So you can choose from July 1 through July 1 of the following year, if that is going to help you reach the 330-day threshold, which is obviously different from the bona fide residency test. So to summarize, this test doesn't depend on the nature or the purpose of your stay abroad, nor your intentions about returning to the US. It's solely based on the duration of your stay outside of the US. You could go to the next slide, please. So in addition to the FEIE, you may also be able to claim foreign housing expenses as an additional deduction or exclusion from your foreign income. I say exclusion or deduction because employees can claim the housing exclusion and self-employed taxpayers can claim the housing deduction. So what housing expenses can be claimed? So things like rent, utilities, real and personal property insurance, renting furniture, repairs, residential parking, these are all eligible housing expenses that can be claimed. Things that cannot be claimed include the cost of purchasing or making improvements to a home, mortgage interest and real estate taxes, purchased furniture, television costs, or domestic help. So how much housing expenses can be claimed? The amount of the housing costs available for exclusion is the cost over 16% of the current FEIE. So for 2023, that's going to be $19,200. Limited by 30% of the FEIE, which is $36,000 for 2023. Now this limit may be higher for some locations. For example, the 2023 limit for Abu Dhabi is $49,687, which is 41% of the FEE, and it is $57,174, which is 48% of the FEE for Dubai. There's also some important limitations of the FEIE to keep in mind. You cannot use the FEIE and also claim foreign tax credits on the same excluded income. You would only be able to claim foreign tax credits on the portion of the income that exceeds the FEIE threshold and is therefore not excluded from tax. In addition, you cannot take the deductible portion of the child tax credit when you claim the FEIE, and your IRA/SEP contributions may be limited or eliminated entirely if you exclude your income under the FEIE. So overall, it's very important to consult a qualified US tax professional, such as people like ourselves, in order to determine the benefits and negatives of claiming the FEIE in your individual case and determine what's best for you. And you can move to the next slide. So Natalia will be speaking on the foreign account and asset reporting obligations for U.S. persons living abroad. So Natalia, take it away.
Thank you, Kyle. The Foreign Bank and Financial Account Report, FBAR, is often overlooked by U.S. persons living abroad. FBAR was mandated by the Bank Secrecy Act of 1970 to address money laundering and was reinforced after September 11 terrorist attack. U.S. persons are required to file an FBAR if they have a financial interest in or signature authority over financial accounts located outside of the U.S. if the aggregate maximum value of all such accounts at any time during a calendar year exceeds the equivalent of $10,000. So who is a U.S. person for FBAR purposes? A U.S. person includes a U.S. citizen, U.S. resident, and all forms of U.S. business entities and trusted estates. For purposes of the FBAR, a financial account includes bank accounts such as savings, checking, certificate of deposit, investment accounts holding security, commodity futures, options, mutual funds, and ETFs, various types of foreign retirement accounts, insurance and annuity policies with cash surrender value, and cryptocurrency if it is held in foreign accounts with other assets subject to reporting. A foreign financial account is in a financial institution located outside of the U.S. The account held in HSBC Middle East branch is a foreign financial account reportable on FBAR. The account held in HSBC New York branch is not a foreign account and does not have to be reported on FBAR. Next slide, please. Thank you. So what is a financial interest? Generally, a U.S. person has a financial interest in an account if the person is the owner or title holder of the account. It does not matter if the account does not generate any taxable income. But a financial interest in foreign accounts can arise through ownership of foreign entities in which a U.S. person has a direct or indirect interest that is greater than 50%. For example, a U.S. person owns 70% of stock of a UAE corporation, and the corporation maintains bank account in UAE. So the U.S. person has an FBAR reporting obligation with respect to the account of the UAE corporation. If two people jointly own a foreign financial account, then each person has a financial interest in that account, and each person must report the entire value of the account on an FBAR. There are some exceptions for spouses. Surprisingly, if a minor child is a joint owner of the account, the child also has FBAR filing obligations if the filing threshold is met, because there is no minimum age or income level at which an FBAR filing is required. If a U.S. person has signature authority over a foreign account, the account is FBAR reportable. Even the U.S. person has no beneficial interest in this account. It usually applies to bank accounts of a company for which the person works. So how to determine FBAR filing requirements? To determine FBAR filing requirements, the maximum value of each foreign account must be converted to US dollars. The maximum value of an account is a reasonable approximation of the greatest value of the account during the calendar year. To convert foreign currency into US dollars, the US Treasury Department exchange rate on the last day of the calendar year must be used. So if a US person has the equivalent of 5,000 US dollars in one foreign account, $1,000 in second foreign account, and $8,000 in third foreign account, they must file FBAR and report each account since the total value of all foreign accounts exceeds 10,000 US dollars. If a person has 36,724 dirham in foreign accounts in 2023, they have to file an FBAR. The FBAR is not part of US tax return. FBAR is electronically filed on Form 114 with the Financial Crimes Enforcement Network, FinCEN. That's an agency under the Department of the Treasury. If the US person is not required to file a US tax return for the given year, they still need to file an FBAR if the FBAR filing threshold is met. The due date to file an FBAR is April 15, and it is automatically extended to October 15. The October 15 is a final deadline. Next slide, please. Thank you. The FBAR filing is important because the failure to comply with the filing requirements carries large penalties. There are two categories of penalties: penalty for non-willful violation and a willful violation penalty. Non-willful violation means that US person did not know and reasonably could not have been expected to know that he or she needed to file an FBAR. The penalty for non-willful failure to file FBAR is up to $10,000 per year per form. The $10,000 is adjusted for the inflation. As of 2024, the penalty is $16,117 per report. Willful violations occur when a US person knew or could reasonably have been expected to know that they needed to file an FBAR. US persons who willfully fail to file the FBAR are subject to a penalty equal to the greater of $100,000 or 50% of the aggregate account value. The $100,000 is also adjusted for the inflation. As of 2024, the penalty is $161,170 per report. Thank you. The next US tax risks related to offshore investment accounts. Kyle, let me pass it
Thank
to
you,
you.
Natasha. I think we have to advance the slides a little bit. Keep going. Keep going. There we are. Okay, so we're
We
gonna
have to, sorry, we have to do the FATCA reporting.
So I'm sorry. So slide
Skip over the
17.
FATCA reporting, sorry.
Yes, in addition to the annual FBAR requirements,
You
certain
want to go to
US
slide 21?
Yes.
Slide 21, one more. Thank you.
Thank you. In addition to the annual FBAR requirement, certain US person must also file Form 8938, Statement of Specified Foreign Financial Assets under Foreign Account Tax Compliance Act, FATCA. FATCA was enacted by US Congress in 2010 to address tax evasion by US persons using foreign accounts. Form 8938 does not replace FBAR filing requirements. For Form 8938 purposes, foreign financial assets include bank accounts of all kinds, investment accounts, stock in foreign companies, interest in foreign partnerships, foreign pensions, foreign mutual funds, precious metals held indirectly. Foreign financial assets do not include personal property and real estate held directly. Next slide, please. Form 8938 filing threshold depends on the US person's residency and filing status. It is completely different from FBAR filing threshold. US persons living abroad must file Form 8938 if the total value of all their foreign financial assets exceeds $200,000 on last day of the year, or $300,000 at any time during the year. A joint filer's threshold is $400,000 and $600,000 respectively. US persons living in the US must file Form 8938 if the total value of all their foreign financial assets exceeds $50,000 on last day of the year, or $100,000 at any time during the year. A joint filer's threshold is 100,000 and 150,000 respectively. Unlike the F-bar, taxpayers file Form 8938 with their federal income tax returns. Accordingly, the due date for Form 8938 is the same. There is no income tax return filing obligation for the given year. Form 8938 is not required. It doesn't matter how much the value of foreign specified accounts is. The form is not required if there is no US tax return. Next slide, please. Thank you. Failure to file Form 8938 by the due date may result in a $10,000 penalty with an additional $10,000 per month up to $50,000. So now, Kyle, US tax risks related to offshore investment accounts.
Thank you, Natalia. So yeah, so we'll start with this slide here. We want to quickly touch on a particular US tax risk that's associated with some offshore investments, such as owning what's called PFICs, which can be fairly common for US persons living overseas. Obviously, this is going to be a very high level view of a complicated issue that deserves its own presentation entirely. But we want to at least make you aware of this very highly punitive US tax regime, which applies to investments by US persons, primarily in offshore mutual funds or offshore ETFs, along with some other offshore corporations that primarily have passive assets and which generate passive income. And these PFICs are what's called passive foreign investment companies. The PFIC rules were essentially designed to discourage US taxpayers from investing in offshore corporations and prevent them from deferring tax on this passive income earned through these offshore corporations. Now, the tax on PFICs is very complicated, but generally speaking, the tax applies in two parts. First, any excess distribution or dividend from a PFIC or gain recognized on the sale of a PFIC is subject to tax in the US at the highest average marginal income tax rate that's in effect while the US person held the shares of the PFIC. Now, on top of this, there's also an interest charge that's calculated based on the period of time that the US person held the shares of the PFIC, which is then added to the overall tax liability. So in effect, this can result in a US federal tax rate close to 50% in certain cases. So the lesson here is to avoid investing in foreign-based mutual funds as a US person, or simply dispose of the shares within the same year they were acquired. Again, this is another topic that if it does apply to you, certainly consult a qualified tax firm such as ours to kind of determine the best approach to come into compliance with PFIC reporting, which is very complicated, and minimize the potential tax consequences. You could advance to the next slide.
I'm going to take over here for gifts and inheritance from non-US persons and gifts by US persons. This is often very much overlooked. Next slide. Effectively, a gift or inheritance of the US equivalent of more than $100,000 in any tax year from a foreign person or estate is reportable on a special form 3520. So, for example, if your uncle leaves you a piece of property that's worth $150,000, whether you need to report that gift inheritance in the year in which you receive it. Gifts or inheritance are not taxable. That is, there's no tax paid on the $150,000 of land that you received. It's only reportable. The problem here is that the failure to file a form when required by the deadline is subject to very high penalties, and so it requires special attention. So Form 3520 is filed separately from the federal income tax and is filed with a different IRS office. And the deadline is the same as the filing deadline of the federal income tax return, namely April 15th, or in our case, June 15th. However, unlike the FBAR, the filing deadline is not automatically extended. So a Form 4868 must be filed to get the extension to October 15th. Next slide. Now, this is I should also point out that the penalty for failing to report an NRA gift, and that applies whether you live in the US or you live overseas. If you receive a gift from a foreign person, the failure to file it is significant, is 25% of the value of the gift, in addition to the 10,000. So 10,000 is basically your lower threshold as opposed to the upper limit. Now, for a US person giving money to a US or foreign person, what happens here? Well, gifts greater than an annual tax exclusion of 17,000 for 2023 or 18,000 for the current year, adjusted for inflation, are reportable on a Form 709. And the annual exclusion applies to each donee. That is, if a US person gives 17,000 to each of his or her children, the annual exclusion applies to each gift. Each spouse can give the same amount to each child. Gifts to US spouses are not taxable. That is, a gift from me to my wife in any amount is not reportable or taxable. Gifts over an annual gift exclusion reduce the lifetime gift limit. This is not relevant for most human beings, most US persons, because it's 12.9 million this year, and it'll be 13.61 million next year. Now, how does that work? Essentially, if you give a gift in excess of 17,000 to an individual, the amount over 17,000 gets deducted from the 12.92 million. So it doesn't make much of a dent. If the lifetime exclusion is exhausted, the gift tax will apply, and that's 40% of the excess amount of the gift. The donor is generally responsible for paying the gift tax. So if somebody gives you $50,000 and for some reason there's tax due on that, you receive the $50,000 tax-free. The person who gave you the $50,000 is the one who's responsible for reporting the gift and paying the tax. Form 709 is filed separately from the federal income tax return with a different IRS office in Kansas City, Missouri. The deadline for filing Form 709 is the same as the filing deadline of your US federal income tax return. But unlike the FBAR, the filing deadline is not automatically extended. So you have to file Form 4868 to extend the filing for 709 to October the 15th. All right, next slide. All right, I'll pass it back over to Kyle.
All right, thank you, Stephen. So this, you could advance the slide. So this next topic addresses the US tax and reporting obligations for US shareholders or partners of foreign businesses such as corporations, partnerships. This first type of reporting we will discuss is regarding what's called controlled foreign corporations, otherwise known as CFCs. But taking a step back, before explaining when a foreign corporation is a CFC for US tax purposes, we must first determine whether the foreign entity is actually a corporation for US tax purposes. The general rule, the determining factor in the analysis, is whether the foreign entity is subject to income tax in such foreign jurisdiction, separate and apart from its owners. And when that's the case, that's generally a corporation. So what is a CFC? The determination of whether a foreign corporation is a CFC is a two-part test. First, the US shareholders must collectively own more than 50% of the total vote or value of the company during the taxable year. And this must be over 50%. It can't be 50%. It must be at least 50.01. The second part of the test is each US shareholder must individually own at least 10% of the company to meet the over 50% threshold. So an example of this, let's say John owns 15% of the vote and value of a foreign corporation as a US person, and Michael, another US person, owns 40% of the vote and value of the same foreign corporation. So collectively, they both own more than 50% of the corporation, and individually, they both each own at least 10%. However, let's change the facts a little bit. Let's say John owned only 5% instead, and Michael owned 50%. This would actually not be a CFC. That's because John does not own at least 10% of the company, and Michael does not own more than 50% of the company on his own, despite the fact that they collectively own more than 50%. So what happens if you are a US shareholder of a CFC? Well, you're required to file a form that's called Form 5471 with your US tax return. It's filed as an attachment to your tax return. It's a rather lengthy substitute US corporate tax return, essentially. It has an income statement and a balance sheet for the foreign corporation. And because this corporation has no US tax filing responsibility as a foreign entity with presumably all foreign activity, the responsibility then falls on its US shareholders to essentially file a tax return on the company's behalf. So that's kind of the framework for this filing. The failure to file a Form 5471 can lead to substantial penalties, starting at $10,000 per year of noncompliance. Now, on top of this international reporting obligation, US shareholders may be subject to tax on their share of undistributed net income earned by the foreign corporation, as though the US shareholder actually received such income. And then there are two tax regimes for US shareholders of CFCs. There's what's called GILTI and Subpart F. So we'll begin with what is GILTI. GILTI stands for the Global Intangible Low Tax Income. And this essentially includes all active business income earned by the foreign corporation. The GILTI provisions were enacted under the Tax Cut and Jobs Act of 2017. And the primary goal of this was to force the repatriation of undistributed earnings and profits from offshore entities that are owned by US shareholders. This is particularly with the motivation of targeting large multinational companies, but this has impacted even sole shareholders and closely held family offshore companies. So next slide, please. So when does GILTI apply and how is it calculated? The GILTI tax applies to US shareholders that own more than 10% of controlled foreign corporations that earn active business income. So, for example, a US person owns 100% of a foreign corporation that earns $200 in active business income in a given tax year. The foreign corporation incurs expenses that are directly related to this active business income of $80. So in this case, there is a GILTI inclusion of $120, which is the net income. This undistributed net income of $120 would be included in the US shareholders' ordinary taxable income, subject to their graduated tax rate. So say their tax rate is 33% based on the total amount of their total ordinary income. They would pay about $40 in US income tax on the GILTI inclusion. Now, this is a very oversimplified example. It removes several layers of the calculation just for the purposes of this general presentation on the topic. And It's worth noting there are a few elections that may be available to US shareholders to potentially minimize the taxation on GILTI. We won't really dig into these concepts, but just to give a high level overview of it, there's something called a Section 962 election. And this allows US individual shareholders of CFCs to reduce the GILTI inclusion by 50% and be treated as a corporation with respect to this GILTI income. Therefore, you're taxed as though you're a corporation on such income at the US corporate tax rate, which is 21%. So depending on the situation, this could be beneficial in cases where you have a higher graduated tax rate, say 33%, you're now capping it at a flat rate of 21%. Now, the second benefit of this election is you can also claim up to 80% of the foreign taxes paid by the foreign corporation on such income to reduce the US tax on GILTI, so in the form of a foreign tax credit. Now, there are other elections such as a high tax exception, which allows shareholders to fully exclude their GILTI income if the CFC's corporate income tax rate in that foreign country is at least 18.9%, which represents at least 90% of the US corporate tax rate. So again, I suggest reaching out to a US, international tax firm such as ours, if this applies to you, in order to discuss kind of the different options that you might have if you're faced with this situation. So next slide, please. Now, I mentioned earlier there were two different tax regimes that apply for US shareholders of CFCs. There was GILTI, which we just covered, and there's also Subpart F. So they're basically two baskets. So what is Subpart F? Subpart F income is essentially all items of income that aren't GILTI or not active business income. So this is generally passive or investment income, such as interest, dividends, certain rental income, capital gains, royalties, etc. There are other categories of Subpart F income that are kind of beyond the scope of this high-level overview for our purposes. So when does Subpart F apply, and how is this calculated? The Subpart F income tax applies again to US shareholders that own more than 10% of a controlled foreign corporation, which earns passive income. So to borrow from the same example before, US person owns 100% of a foreign corporation that earns $200 in active business income, $80 in dividend income, and $20 in interest income. In this case, there's $100 of Subpart F income, the 80 dividends and the 20 in interest, which is then included in the US shareholders' ordinary income, subject to tax again at their graduated tax rate. So assuming again their tax rate is 33% based on the total amount of their ordinary income, they would then pay $33 in US income tax on their Subpart F income. Now, if a foreign tax is paid on this income by the foreign corporation on the dividends and the interest, the US individual shareholder on their tax return may be able to claim a foreign tax credit to reduce the US tax on the Subpart F income. Once again, there's Section 962 election and high tax exception for Subpart F as well, that you may be able to reduce Subpart F tax in certain cases. And there's some slight differences in how they function relative to the GILTI regime, which again, we're not going to cover in this presentation. Advance to the next slide, please. So the final portion that we'll discuss is foreign partnerships. As we mentioned earlier, a foreign entity is generally considered a corporation for US tax purposes when it's subject to tax in that foreign jurisdiction, separate and apart from its owners. So in the case where this foreign entity isn't subject to tax in the foreign jurisdiction and there's more than one owner of such entity, the entity will be considered a partnership for US tax purposes. So in this example, say a US person owns 55% of the foreign partnership and a non-US person owns the remaining 45%. In this case, the US person will be required to file what's called Form 8865 with their US tax return, again attached with the return. Again, this is essentially a substitute US partnership tax return because this entity has no US tax filing responsibility. So that responsibility falls on its US owners to essentially file a tax return on the company's behalf, similar to the Form 5471 that we discussed earlier. And the failure to file this form can lead to substantial penalties, starting at the same $10,000 per year of noncompliance. It's also important to note that the US partner needs to report the financial information consistent with the US partnership tax rules to properly report the income from the foreign partnership on their US return. Essentially, the net income from the foreign partnership is going to flow directly through to that US partner's ordinary taxable income, subject to tax at their marginal rate. It works the same way as a US partnership would. The US partner should be eligible to claim a foreign tax credit against his US tax liability relative to the share of that foreign partner's net income. Lastly, let's say the foreign entity is wholly owned by a US person with no other partner. This is going to be classified as a disregarded entity for US tax purposes, which means that the US person will now have to file a Form 8858 with his or her income tax return. All right, next slide, please. All right, now Natalia will speak on some potential relief if we have some delinquent US tax filers in attendance here.
Thank you, Kyle. During the presentation, we addressed the penalties for not filing various international reporting forms. Now we will discuss the IRS amnesty program available for US persons living abroad. Back in 2014, the IRS introduced the Streamlined Foreign Offshore Procedure program, SFOP, to encourage US persons living outside of the US to become current with their US tax and FBAR filing obligations. The SFOP is a very good program and should be considered for those that qualify. Filing under the SFOP eliminates all tax, international information, returns, and FBAR penalties. And again, during our presentation, we covered various international informational report penalties for not filing FBAR, Form 8938, Form 3520, Form 5471. There are more penalties associated with tax, a failure to file, failure to pay, and accuracy-related penalty. The great benefit of the SFOP that the taxpayers filing their returns and FBARs under this program are not subject to any type of penalties. The individuals have to pay income tax for the last 3 years and interest, but again, there is no penalty. As an initial matter, the SFOP is not available for a taxpayer that is already under examination by the IRS for years that are subject to the program. What should be done and who qualify for the SFOP? First of all, to enter the SFOP, a US person must have a US tax identification number or a social security number. A US person also must meet the non-residency requirement. The person meets the non-residency requirement if in any one or more of the most recent 3 years for which the US tax returns due date has passed, the individual did not have a US abode, and the individual was physically outside the US for at least 330 full days. In addition, the US person must have unreported gross income from foreign financial assets. Finally, the taxpayers must certify under penalty of perjury that their failure to report all income and submit all required informational returns, including FBAR's Form 8938, was not willful and provide an explanation of why they did not report the foreign income and did not file FBAR. Under the SFOP, the taxpayers must file the tax returns for each of the most recent 3 years for which US tax return due date has passed. For example, if the SFOP is filed before June 17, 2024, it should include tax returns for tax years 2020, 2021, and 2022. After June 17, the 2023 return will be late. So if the SFOP is submitted after June 17, it should include returns for 2021, 2022, and 2023. And it assumes that there was no extension filed for 2023 tax return. In addition to filing the returns, the taxpayers must also file delinquent FBARs for each of the most recent 6 years for which the FBAR due date has passed. The SFOP submission must also include a statement made on Form 14653, certifying that the taxpayer is eligible for the SFOP, that all FBARs were filed, and the failure to file resulted from non-willful conduct. The statement of facts is one of most important part of the SFOP. A US taxpayer that reported all their foreign income on their US tax return, but failed to file an FBAR does not need to enter the SFOP. There is another program called Delinquent FBAR Submission Procedure that can be used to file FBARs without facing a late filing penalty. Next slide, please. There is no filing deadline for the SFOP submissions because the returns and FBARs being filed are already late, but the SFOP will not be available indefinitely. The IRS has stated that the SFOP will close, but has given no date. So it is important for US persons with undisclosed foreign accounts or income to resolve their tax matters sooner rather than later. Thank you.
So we're now open for questions.
This is great. And I just want to say before I get into the questions on the chat that I now know why you all are so well compensated and such an invaluable resource. My God, the things you have to know. Weren't they supposed to uncomplicate the tax code, Stephen? That's incredible.
Well, no.
I am endlessly impressed with all of this information. I'm going to go to the top of the chat box and we'll start with Asan. This recording will be sent again to all persons who have attended this event, as well as available on our AmCham YouTube channel sometime tomorrow. Our first question, Stephen, I don't know if you can see it in the chat, is from Karen. Can you see the chat?
The chat? Yeah, I'm going to get the chat up. Let me get it up here. Okay. Let's see.
Karen Dufour.
Let me see. No, I don't want to jump to the latest. It's asking me to jump to the latest, and
all right, I'll read it to you.
Yeah, please.
At the top of the chat, Karen's asking 2 questions. Question number 1, what if my services are performed remotely? My company is based, registered in USA, but I perform my services over Zoom for various locations, sometimes in the USA, other months in Saudi or Oman.
The short answer to that is that if they're performed overseas, irrespective of who the employer is, they are foreign source. The rule is where the services are performed. So if I'm sitting in front of a camera in Abu Dhabi and I'm giving Zoom information via Zoom to somebody in the US or to Germany or wherever else, the services are being performed physically from a location outside the United States, and therefore they are foreign source.
Great. And we just want to clarify the required number of months to be working outside the US to be considered foreign income. That is again.
The foreign income depends on where the services are performed, not how long you've been out of the US. So for example, if you were to travel to UAE for 6 months and do certain services in the UAE for 6 months, then the income generated during your 6 months in the UAE would be foreign source. Now, the issue of FEIE is different. That requires you to be outside the US, either under the bona fide residence test or under the substantial presence test, but the source of the income would still be foreign.
Okay, great. So our next question is from Marina. Again, I've answered the question that we will have this available online, this presentation. And if you do have questions, it has contact information for Mr. Flott and his team. Next question comes from Karen. Karen is asking if there's any legislation on the horizon to get the USG to stop taxing citizens abroad. I will tell you from an AmCham perspective, that is not a Stephen Flott question. We do advocate for tax change, but unless I know something different, Mr. Flott, I don't think the US government's in any rush to stop taxing citizens abroad. What do you say?
There's a practical political problem here, and that is that while we have many millions of Americans living overseas, we have far many more millions living in the US. So the problem for Americans living overseas is this constituency issue. And that's really the problem. It will surprise the listeners to know that the citizenship taxation originated in the very first Income Tax Act that was passed during the American Civil War. The United States, to finance the war, the northern part, obviously, wanted to make sure that people didn't go off to England to avoid payment of the tax. So they doubled the tax for any US citizen who lived outside the US. Well, when that original Income Tax Act was effectively revoked, then the 16th Amendment was passed. And so in 1916, the United States was able to pass the first Income Tax Act. They basically used the one that had been passed during the Civil War as a model, and that had citizenship-based taxation, which has existed from the very beginning of US taxation on personal income. So what are the chances of it being repealed? Now, I've certainly had discussions with American citizens overseas and many others, but I don't see it as a practical possibility. That's just a personal opinion.
Yes, I would sadly agree with you, Mr. Flott. Next question comes from Sam. He's asking, is there any reason to choose a bona fide residence test versus a physical presence test for the FEIC if you qualify for both?
Yes, because the bona fide residence test doesn't require you to count days in the US. So we have a client in Belgium, for example, who's a bona fide resident of Belgium, but for a number of reasons, his wife continues to live in the US. So he tends to travel back and forth. So as long as he doesn't establish an abode in the US, basically cohabit back with his wife in the US on a permanent basis, he can essentially travel here a little more often than he might otherwise do if he's using the substantial presence test. As I said, the bona fide residence test is of the two options is the better one because it has more flexibility. But at the same time, it has other limitations and that create traps for the unwary, such as this idea of a tax home or abode.
And that is his question. Follow-up question is, does using the bona fide residence test 1 year allow you to continue to use it in future years that may not qualify? For example, I spent all of 2023 abroad, but plan to visit my family for 3 months in 2024 before returning back abroad. So
generally, I would say that would not undermine the bona fide residence test if the person is simply visiting family and they're going to have an extended period. It gets on the border. We've done an extensive amount of work in tax controversy with the bona fide residence test. And So feel pretty comfortable in making the factual distinctions that fit into one category versus another. But generally, spending long time in the US does tend to undermine the bona fide residence. But for example, if this particular person has every connection, business, work, banking accounts, friends, connections in UAE, Abu Dhabi, but the family is going to take a 3-month vacation to visit grandparents and uncles and aunts in the US and then return to UAE, it probably is not going to undermine their bona fide residence test qualification.
Mr. Decker asks, would it make sense to create a blocker corporation in the US and transfer UBTI into regular corporate income to maintain the tax exempt status of an investor? This would primarily be used for non-US citizens that don't want to be subject to US tax filing requirements, but might it be an advantage to a dual citizen as well?
Wow. Well, Mr. Decker, you've raised a really big question, because there are cases where the Tax Cut and Jobs Act can be very beneficial to a US person with foreign business activity. And it's probably a little long and involved to get into here for the general audience. We advise people in many countries who are US citizens and people who are not US citizens about investing in the US. Typically, somebody from UAE who is not a US citizen doesn't really get much advantage. Not a lot of planning you can do on certain issues. Whereas for a US citizen, there may be more. For example, dividends from a UAE corporation would not be subject to the preferable dividends tax rate in the US, because they're not taxed as ordinary income, because the US doesn't have a tax treaty with UAE. Whereas if we convert that to a subsidiary of a US corp, we can get those dividends into the US and into the hands of the US shareholder at preferential rates. I won't go any further into it, but there are ample opportunities for planning effectively, but it's not a simple answer to any given fact pattern. It takes some doing and thinking.
Sounds like a future client, perhaps, sir. Sam is asking, does a foreign Stripe account qualify for FBAR filing? Stripe is a point of sale service that a lot of small and medium enterprises use, similar to a credit card machine that, takes payments, credit card payments. So we have a company called Stripe here. So she wants to know, does a foreign Stripe account qualify for FBAR filing? I was told by the Stripe company representative, you use your Stripe account just to receive gross payments from your customers, and then these funds are sent to your personal bank account. But if Stripe has no bank account connected to the merchant's Stripe has no bank account connected to the merchant's Stripe account. So the Stripe bank information is not needed, and we never share it with the merchants. So
where I would say, if there's no funds on deposit in the Stripe account, which doesn't sound like there is, then it's not a reportable account.
Okay, this sounds like
it's really for what the US is after here is where like PayPal and other things that are simply pass-through entities where you're using them as a mechanism to receive funds. They are not accounts, because you don't keep money on deposit in them like you would in a bank. Now, if a Stripe account does have a case where you collect money in it, and then you later determine that you want to disperse that money, then that would be a bank account.
Follow-up question. Would we need then to report each foreign currency in a WISE account as separate accounts for the FBAR?
I confess my lack of knowledge about WISE.
Another type of bank account, because we have many currencies here, Mr. Flott. WISE is a company that can accept payments in many different currencies.
Okay, got it.
They choose to carry their money in different currencies.
No, everything gets converted into USD. So if you have dirham and you've got euros and you've got pounds and you've got some other currency, that all is, and it's in one account, then you just have to convert the various amounts into USD using US Treasury conversion amounts to get to one USD total.
Compliment on the PFICs, and from a personal point of view, I almost made the mistake of an investment on a PFIC, and the sellers of said mutual funds here are not astute as you are about these tax implications. So Americans beware.
Yeah,
Question.
that's really important because it's one of those crazy things where I don't believe the US Congress, when it enacted the PFIC rules, the PFIC rules, ever really meant to cover foreign mutual funds. But the problem is distinguishing a foreign mutual fund between that and a passive investment is very difficult. So, for example, where US persons, and again, this creates another difficulty, a US person wants to invest in a US-based mutual fund, often the investment companies won't accept investments from US people with foreign addresses. There are some who are overcoming that as a practical matter, but it is better to invest directly in stocks or bonds than to use mutual funds or ETFs. The other option is to, when you want to invest in a mutual fund, is contact a competent tax advisor, and they can advise you to make something called a qualified electing fund election. It's called a QEP election. Assuming you can get the reporting information necessary, you can convert what would otherwise be a PFIC into an ordinary everyday garden variety investment and pay tax on a current basis and avoid the negative consequences of the PFIC. But you have to be able to meet certain rules for reporting.
Thank you. Mr. Asan has a question. I gave a family member who is not a US citizen a zero interest $100,000 loan, and they paid me back the next year. Do I have to report this loan on my taxes?
Loans aren't reportable. If you make a loan, that's not income. Now, the problem with a zero interest loan for a US person is that typically is subject to a Kyle help, or Natasha will help remind me what the name of that is. It's a minimum interest charge that the IRS assumes people don't lend money for zero. So for a US person, quote, lending money that's not a gift, they would assume to get some amount of interest from the person to whom they gave the money to. So sometimes there's imputed interest that would be reportable by the US person. So all that would be reported here is the imputed interest. I won't go into it here, but be aware that the IRS doesn't consider loans at zero interest to be loans at zero interest.
Got it. The Dubai International Financial Center, a free zone in Dubai, DIFC, has their option to create a foundation under Law 3 of 2018 here in UAE. Decker says, from what I understand, this is similar to a trust. For estate planning purposes, this seems like a good vehicle to use for high value estates. How does the IRS view these foundations? Because based on my review, the property of a foundation is not held by trust for any other person.
I don't think we can answer that question here. I think we'd have to get a better understanding. I don't know. I know nothing about this particular law.
Okay.
So can't say how it would be treated for US tax purposes. Some foundations typically, as Natasha and Natalia will tell you, we've dealt with foreign foundations and they can be a nightmare for US taxpayers.
Decker,
There's a question here, Liz, that you skipped over, and that is, if my foreign husband dies and I get his assets, must I file this form? And the answer is yes.
If it's an IRS form, file it. Thank you. Do you anticipate more versus United States will change the requirements regarding passive foreign ownership of a partnership?
there are people much smarter than me that can't answer that question, so I'm not going to try. I think speculating as to what happens with more versus, for the rest of you, that relates to a penalty the IRS assessed to someone who failed to report income. He paid the amount of tax and now is challenging the validity of the guilty regime?
It's the repatriation.
Yeah, the repatriation transition tax. I had to remember what that was. In the Tax Cut and Jobs Act, just for the rest of the audience, there was a mandated 1 year, one time tax on untaxed, undistributed foreign source income. Under the previous regime, if you had a CFC, you could fully defer tax on all the earnings and profits of that CFC if it conducted an active business. Under the Tax Cut and Jobs Act, that full deferral was removed, and that's when the GILTI regime came into place. Now, to make a transition, the IRS forced all of those persons who had CFCs from 1986 to 2017 to go through a calculation of their undistributed foreign net income that had not been subject to US tax, and then pay a tax on it, giving them 8 years to pay. Moore challenged that. He had an investment in an Indian company, and he was a principal of that company. So the Supreme Court is considering whether that is constitutional or not under a somewhat arcane provision of the Constitution relating to the way in which we can tax. First of all, I have no idea how the Supreme Court will rule. There's a lot of speculation about it. My sense is that the U.S. extraterritorial tax regime that applies will continue.
Sam says, does claiming the foreign earned income exemption or foreign tax credit 1 year require me to continue claiming it in subsequent years? For example, if I claimed FEIE in 2023, but don't want to claim it in 2024 because the child tax credit's more beneficial, is that okay? Or do I need to do anything to stop claiming foreign exemptions?
I'll let Natalia answer that question.
You can certainly revoke the FEIE to claim the child tax credit, but however, after revoking the FEIE, you cannot claim it again within the next 5 years. So there is an option, but in this case, the taxpayer must contact the IRS in written, and the chances that it will be allowed are very small. That's a long bureaucratic procedure. So again, if that's only applies to 1 year, it will require more planning going forward. But again, revoking the FEIE for 1 year will preclude taxpayers to claim them during next 5 tax years.
And again, for UAE taxpayers, there is no foreign tax credit. So it's a moot point. Obviously, if we have one, where there's no foreign tax on income, there is no foreign tax credit.
Let's see. If a U.S. person receives a property gift outside of the U.S. from another U.S. person living abroad, what forms do I need to fill out? Is that form 3520?
No, a U.S. person giving foreign property to another U.S. person is going to be covered by Form 709. It's only a gift from a foreign person. So the issue is if the donee of the property or the deceased person whose estate is being left to you, or portions of his estate is being left to you, is a foreign person, even if it's U.S. property, it still has to be reported as a 3520. U.S. person to U.S. person gifts or inheritances are filed on Form 709 or Form 706 if it's a estate tax return.
Well, I'm giving you a solid 100 for knowing all those different numbers off the top of your head, Mr. Flott, because that's pretty impressive. That concludes our questions, and I just want to say to those of you who might be watching this post-event on the video, we will include contact details for Flott Co. They've been friends all along for AmCham for a number of years. I've been in contact with the Flott Co. company for 6 years, and I know we've had dozens of very, very happy AmCham members utilize and confer and work with the team at Flott. So it's not an ad. I'm just saying from personal recommendation, these folks know your pain living abroad. I'm going to give the floor to Mr. Lobach for some closing words.
Sure, and I'll try and keep my closing remarks brief. I just want to say thanks so much to Stephen, Kyle, Natalia. It's, we hear these talks about the obligations of U.S. taxpayers to file returns and make payments, but it bears repeating every time. No one wants to wind up missing something or failing to file a form or forgetting about a gift or an inheritance. And in fact, today, the comments you made about gifts and inheritances, about foreign corporations and partnerships, and this SFOP, these are, I mean, I may have heard part of those before, but like I said, it's always good to be reminded. And thanks. It's good to know some people are out there who know these details, because I don't think there are many people here in the UAE that know the ins and outs of the problems that Americans overseas face, American taxpayers overseas are facing. So, I mean, I'm on the board of the Abu Dhabi AmCham. Thanks so much for this. You help us navigate a very unpleasant situation that has no end in sight. I guess it gets more complex, it seems to me. So all the more need for guidance from time to time. So thank you once again, Stephen, Kyle, Natalia. Very, very interesting. And all of those of you who dialed in by Zoom, thank you for your question. The questions were excellent. It shows you've really got your gray cells working on this, and maybe you face as much chagrin as I do, but great. I mean, we're all in this together. But thanks for your participation, your support. Thanks for the questions. You have my sympathy during tax season, and for what that's worth. So, and we'll do this again next year, year after. It's not going to go away. It's always there. Don't forget your 4868 forms, and don't forget your 1040s, and all the rest, all those other forms that come along. So thanks so much, everybody.
Again, thank you, and you're most welcome. It's been our pleasure.
This concludes the event, and wish a wonderful day to Mr. Laubach and Team Flott for joining from the U.S. For the rest of our AmCham members, so wonderful to see you. Look forward to seeing you in person soon. Have a great evening. File those forms. Thank you.
Bye.
Bye.
Yeah, bye.